Hello, welcome to the seventh module of the course Cost and Management Accounting, and we'll be discussing on standard costing and variance analysis. Standard costing and variance analysis. When we talk about standard costing, we will look at the meaning of standard costing and the purpose. We look at the setting standard and analyzing variances, and we look into material, labor, and overhead variances. To understand standard costing, a cake formula actually tells the exact amount of flour, sugar, and egg that is supposed to be used for a particular baking. And that's actually talking about the standard. That's the standard of what is expected to be used to be able to make a perfect cake. And standard costing on that works the same way in business. It involves setting predetermined costs, the receipt, and for material, talking about how much should it cost, the labor, how long should it take, and overhead, what should indirect cost be. And the goal of this is to create a benchmark for efficient operation. Also, in comparison, later we compare this should be costs to the what actually happened. That's should be cost is the standard and what actually happened is the actual. And the difference between the standard cost and the actual cost is actually the variance. And when we talk about the variance, it can either be favorable or unfavorable. And then when we talk about it being favorable, it's when it is good. That is, actual cost was lower than the standard. That is, we save money rather. And when it is unfavorable, it means a bad output, which means the actual cost was higher than the standard, meaning that we overspent at such instance. Why do we use standard costing? The first is for cost control. That is, it acts like a financial alarm bell. If costs are higher than the standard, managers know to investigate need to investigate immediately. And for performance measurement, it is needed for performance measurement. That is, it helps answer how well is our team, the department, doing by comparing their actual results to the benchmark. And also, why do we need standard costing? It's needed for management by exception. That is, managers don't have to watch everything. They can focus their attention only on the areas where there is significant variance. That is a big difference between the standard and the actual. And another reason is budgeting and planning. Talking about the realistic standard foundation for creating accurate budget. And lastly, the reason to use standard costing is because of its motivation. That is, clear targets can motivate employees to work efficiently to meet the standard. What kind of standard should be met? We have a number of standards. We have the ideal standard, we have the basic standard, we have the attainable standard. As per the ideal standard, this is a perfect condition where there is no waste, no error, no downtime, and it's almost impossible to achieve this. So it can be discouraging as it is mainly used for long-term dream goals. We have the basic standard, which is a long-term unchanging standard used for comparing trends over many years, and it is not good for day-to-day control as they become outdated. And the last one is the attainable, which is the practical standard. The practical standard, attainable, which is practical actually. It's practical, and this is tight but achievable, and it allows for normal expected inefficiencies like short break or minor material waste. And this is the most recommended type, as it is, though it's challenging enough, it is challenging enough to motivate employee, but not so hard that it causes frustration. As per the variance analysis, this is actually the process of calculating, understanding, and responding to the difference between standard and actual cost. And the step involved in variance analysis include: one, identifying the variance, that is, you determine the difference between actual and standard performance, and this can apply to material, labor, or overhead costs. And each variance is calculated to pinpoint where deviation occur, whether in price, in quantity, efficiency, or spending. Another step, the next step is analyzing the causes. That is, why did it happen? After identifying the variances, management must investigate the underlying causes. Maybe did we pay more for material, or did we use too many hours of labor? And the last is the taking corrective actions. And this is the final step which involves implementing appropriate means to correct inefficiencies or capitalize on favorable trends. And this turns accounting from just recording history into a tool for managing the future. We have the material variance, and the material variance measures how effectively raw materials are managed and utilized in the process, in the production process. We have the formula there, the MPV plus MUV. And when we talk about MPV, it's actually the material price variance, which shows the effect of paying a different price than the standard price for materials. And when we talk about the MUV, which is the material usage variance, it reflects whether more or fewer materials were used than the standard quantity allowed for the actual level of production. And it measures the efficiency of the production processes. We also have the labor variance. And when we talk about the labor variance, it focuses on the difference between the standard and actual labor cost. And the labor variance assesses both wage rate and time efficiency, thereby offering insights into human resource management and operational efficiency. And we have the key formula there: total labor variance is equal to the labor rate variance plus labor efficiency variance. When we talk about ZRV, it actually measures the impact of paying a wage rate different from that standard rate. And for the labor efficiency variance, it actually arises when the actual time taken to collect and complete a job differs from the standard time allowed, and it reflects the productivity and efficiency of workers. We have the overhead variance also, which represents all indirect costs incurred in production, such as factory rent, maintenance, and depreciation. And overhead are split into variable, that is changed with production power, and fixed, just like we've been saying. And we can see it divided into overhead variance and fixed overhead variance. Variable overhead variance measures the difference between the standard and actual overhead incurred for actual production, and the fixed overhead variance relates to differences between budgeted and actual fixed overhead costs. The fixed overhead remain constant within the relevant range of activities that are being performed. In conclusion, standard costing and variance analysis are not just accounting exercises. They are a powerful management tool for controlling costs and stopping mistakes, evaluating performance fairly and accurately, making better decisions on facts, not guesses, and driving continuous improvement by constantly asking the question, how can we do better than the standard? And by doing this, having an understanding of this, of what should happen, and comparing it with what did happen, managers can steer the company towards greater efficiency and profitability. Thank you.